Your wallet might feel a little lighter the next time you shop for a new smartphone or car. A sudden change in trade policy could soon make some of the most popular consumer products more expensive. The United States government has announced a new 10% tariff on certain goods imported from Canada. This decision stems from a tense political disagreement and has put major industries on high alert. The new tax directly targets goods crossing the border, which could have a significant and noticeable impact on the final prices of products that many Americans use every day. For consumers, this isn't just a distant economic headline, it's a development that could directly affect household budgets and purchasing plans. The conversation is now centered on how this tariff will translate into real-world costs for everyday people. Major companies like Apple, Ford, General Motors, all of which rely on intricate cross-border supply chains, are now facing a new financial challenge. These corporations manufacture parts and assemble products in multiple countries, including Canada. The primary concern is that they won't simply absorb the extra cost, but will pass it along to customers. That shiny new iPhone or the family sedan you've been eyeing could be higher than you anticipated just a few weeks ago. Let's break down what a tariff actually is. In the simplest terms, a tariff is a tax that a government places on goods imported from another country. Think of it as an entry fee that a company must pay to bring products across the border and sell them in a new market. When a company like Apple or Ford imports a component or a finished product subject to this new rule, it owes a 10% tax on that item's value. It's a mandatory cost of doing business that gets added to operational expenses. This specific 10% tariff targets a range of goods from Canada. While the full list is being clarified, it likely covers critical components in electronics and autos. Importers pay at entry, and that cost doesn't just disappear. Companies recalculate total production costs and, to protect margins, factor the new expense into the final price you see in stores or at the dealership. The official reason cites a political ad dispute. Trade talks with Canada were halted and the tariff implemented as retaliation. Canada called the move unfair and against the spirit of long-standing agreements, making the situation volatile and uncertain. The price of your next iPhone is intricately linked to a global network of suppliers, and any disruption can raise costs. Apple sources components worldwide, and some routes involve parts moving through or originating from Canada. If specific components, manufacturing equipment, or raw materials face a 10% tariff on entry to the US, Apple's cost per device rises. It's not just where the iPhone is assembled, it's the journey of hundreds of parts. During prior tariff scares, analysts projected price jumps from $150 to as much as $800 depending on model and scope. A new 10% tariff on Canadian goods adds another layer. Exact increases depend on which parts are taxed, but small bumps across many components add up. Apple might absorb some or all costs short-term to protect share, especially around launches, but history suggests companies don't absorb costs forever. Expect uneven impacts. Premium flagships may see increases while older budget models hold, widening the gap and nudging some buyers to previous-gen devices. Ultimately, if tariffs persist, Apple will likely adjust pricing, and consumers will end up footing more of the production costs. To understand how a tariff inflates price, let's follow a simplified example. Imagine the iPhone 17 Pro at say $300 of components are sourced from or routed through Canada. With a 10% tariff, Apple or suppliers pay extra on those goods. 10% of $300 is $30 per phone, a direct hit to the bottom line, and that's before materials, labor, marketing, shipping, and desired profit. Manufacturers mark up costs to reach retail price. That $30 raw increase can translate to a $40 or even $50 higher sticker price. If $500 of components are affected, the tariff is $50, potentially a $75+ retail jump. A CNN report warned tariffs could raise iPhone prices by up to $800 in other scenarios, showing how fast costs can escalate. With multi-nation supply chains, costs can stack across borders, what one CNBC analyst called a potential tariff Armageddon. Pricing is strategic. Apple may partially pass through now, but sustained margin pressure usually reaches consumers. The question isn't if, but when and by how much. Section 5, the ripple effect, why car prices are set to climb. The auto industry is even more exposed. North American manufacturing is deeply integrated, with parts and vehicles crossing the US-Canada border multiple times, thousands of parts per vehicle. many made in Canada, from engines and transmissions to electronic modules. A 10% tax on these components immediately raises build costs for American automakers. Ford, GM, Stellantis. CarEdge estimated auto tariffs could add as much as $3,000 to a new car. Car and Driver suggested 4% to 8% sticker hikes. 8% on a $45,000 SUV is $3,600 out of pocket. In extreme scenarios, Bank of America, cited by CNBC, warned average prices could rise by as much as $10,000. Vehicle pricing reflects materials, labor, R&D, and vast supplier networks. A key link that's 10% pricier throws the math off. Consumers ultimately bear the brunt. Automakers already face rising inputs and EV transition costs. Tariffs squeeze thin margins further, absorb and risk losses, or pass through and risk demand. Both threaten output, jobs, and a critical U.S. industry. Section 6. Detroit's Dilemma. Ford and GM brace for impact. The reaction has been swift and concerned. Ford warned dealers about tariff-related price increases, signaling it won't absorb the full impact. Retail partners and customers are being prepared for higher prices, with effects felt quickly on showroom floors. GM and others monitor impacts. Executives argue tariffs are a tax on American consumers, harming competitiveness and sales. Reconfiguring supply chains, shifting parts from Canada to the US or Mexico, is possible but slow and costly. Moving equipment, retraining workers, validating quality takes years and hundreds of millions. Meanwhile, tariff costs accrue. Section 7. The view from both sides. Canada condemned the 10% tariff as unfair, unwarranted, and harmful to the partnership. Ottawa vowed to defend industries and workers against what it sees as an aggressive, arbitrary action, signaling it won't back down. Section 8. What can you do now? With higher prices looming, major purchases may be time-sensitive. If you urgently need a vehicle or your phone is dying, acting sooner could lock pre-tariff inventory and save hundreds or thousands. Watch dealer sites and visit showrooms for incentives, cashback, or low-interest financing as brands clear existing stock. Broaden to used cars. The used market often reacts with a delay, offering better near-term value. For iPhones and electronics, compare across retailers. Look for promos, bundles, and slightly older models with similar performance at lower prices. Stay informed. Watch Apple, Ford, and GM announcements, track the trade dispute, and be ready to research, compare, and act at the right moment.